Hey friends, tax season is coming. I've got you covered with a 12-episode Saturday series running January through April. Each week, I'll share tips to help small business owners avoid tax season stress, get clarity, and lighten the load by delegating what you don't need to carry. Tune in every Saturday and step into tax season with confidence. Congratulations! You just landed one of your biggest contracts ever. Depending on your industry, maybe your contract was for $15,000 or maybe it was up to $40,000. You're ecstatic. You're thinking, I finally made it. My business is finally real. And then your first thought is, I deserve that new truck I've been having an eye on. Plus, it's a tax write-off, right? I'm going to be blunt. That thought right there is the most dangerous thought many new business owners will ever make. Is the moment that separates those who build sustainable businesses from those who are struggling 3 years later, drowning in debt, and facing surprise tax bills that they cannot pay. Today, we're talking about the new truck trap, the financial and tax mistakes the new business owners make when they experience the first taste of success. I'm picking on trucks specifically because I've seen this pattern constantly, but this applies to any major purchase justified as a tax write-off without understanding the actual tax rules. I'm Patricia Oholeguy, and this is Tax Season Saturday. There's a specific dangerous excitement that comes with that first really big business check, and it leads to that catastrophic tax assumption. A landscaping contractor, let's call him Marcus, landed a $28,000 commercial property contract within his first year. Within 48 hours, he puts down a down payment on a brand new truck that is worth about $52,000, and he posted on social media about investing in my new business and it's a tax write-off. 3 months later, he couldn't make payroll. 4 months later, he faced his first quarterly estimated tax deadline and no money set aside. Let me explain what went wrong from both cash flow and tax perspective. He had what we call the gross revenue illusion. That $28,000 check wasn't $28,000 of profit that belonged to him. It was gross revenue. He still had to pay his 2 employees $6,500 combined, materials that he had to already put on a credit for $8,200. His actual profit from that project was maybe about $9,000 after all of the expenses were deducted. But he made the decision based on the $28,000 number, not the $9,000 reality. The tax write-off myth? Marcus assumed the $52,000 truck was fully deductible as a business expense. That's not how vehicle deductions work. And this misunderstanding costs new businesses thousands of dollars every year. Here's the tax reality. If you buy a vehicle over 6,000 pounds, many trucks qualify, you can potentially deduct up to $28,900 in the first year under Section 179. Sounds great, right? But there's a massive catch. First, you only get the deduction if you use the truck 100% for businesses. If you use it 80% business and 20% personal, you only get 80% of the deduction. And the IRS scrutinizes vehicle deductions heavily. They know most people use business vehicles for personal purposes. Second, the deduction only helps you if you have a profit to offset. If your business profits was $9,000 and you take a $28,000 deduction, you just created a loss that might not even benefit you depending on your entity's structure and other income. Third, the interest on that truck loan, not fully deductible for most small business structures. This is where new owners get shocked. Let me show you the actual tax implications of the new truck tax write-off that nobody explains clearly. Yes, Section 179 allows you to deduct qualifying vehicle purchases up to a $28,000 for vehicles over 6,000 pounds. But Marcus' $52,000 truck, he can only deduct $28,900 maximum in 1 year. The remaining $23,100 has to be depreciated over 5 years under the standard Mark's depreciation schedule. And that only if he uses it 100% for business. Marcus drives it home every night and he uses it for personal errands on weekend, takes it on family trips. His actual business uses maybe 70%, so that $28,900 deduction becomes a $20,000, $230 deduction. That tax benefit on the $20,230 at 25% effective tax rate, it's really about $5,058. Now, let me explain what is the interest deduction limitation. Marcus financed $47,000 at 6% for 6 years. That's about $240 per month in interest rate alone. Or should we say $2,880 per year. As a sole proprietor, business loans interest is generally deductible, but here's the catch. Only the percent used for business is deductible. If his business uses 70%, only $2,016 of that $2,880 in interest can be deductible. He's paying $864 per year in interest that provided zero tax benefit. And if he formed an S Corp instead of operating as a sole proprietor, deductibility gets even more complicated depending on whether the truck is owned personally or by the business. Then we come to what we call the quarterly tax nightmare. Marcus didn't set aside money for quarterly estimated taxes because he thought the truck purchase would offset his taxes. But that's not how it works. His quarterly tax obligation is based on his profit. He earned approximately $9,000 in profit from that big project. He owes self-employment tax, which is about 15% plus income tax and so on, which is roughly about $2,700 minimum. He didn't have $2,700 set aside because he spent it on the truck down payment. So he missed his quarterly estimated payment, incurring penalties and interest. And the truck deduction that he was counting on, it helps at year end when he files his annual returns, but it doesn't eliminate his quarterly obligations to pay taxes on the profit that he has earned. What should new business owners do instead? What's the smart path that optimizes both cash flow and tax benefits? Here's one option. Use vehicles and bonus depreciation. Here's what savvy business owners know. A reliable used truck for $15,000 to maybe $20,000 provides nearly the same tax benefits as a new one with dramatically better cash flow implications. Under current tax law, used vehicles can qualify for 100% bonus depreciation if they're new to you, meaning you didn't previously own them. An $18,000 used truck used 80% for business gives you a $14,400 first year deduction. At a 25% tax rate, that's $3,600 in tax savings compared to market situation, a $52,000 truck with a 70% business use, effective first year deduction of $20,000, tax savings of $5,000. The difference in tax benefit, it's really only $1,400, but the difference in cash flow impact is huge. He has over $30,000 on a loan term. So that is where the difference is. Sometimes going with an older truck can really be beneficial for your cash flow rather than getting a large long-term loan on a vehicle. Another option is to understand your actuals versus your standard mileage deduction. Many new business owners don't realize you have a choice on how to deduct your vehicle expenses. You can either deduct actual expenses, depreciation, gas, maintenance, insurance, proportional to the business use, or take the standard mileage rate. For new business owners with moderate driving, the standard mileage deduction is often more beneficial and infinitely simpler. No tracking every receipt, no depreciation calculations, no allocation headaches. Just track your business miles, multiply by the cent that is currently in the system, and deduct that amount. But here's the catch. If you want the option of using standard mileage for a deduction method, you must choose it in year 1. when you get the vehicle for your business. If you take Section 179 or bonus depreciation in year one, you're locked into the actual expense method forever for that vehicle. This is a tax trap new owners fall into constantly. The third alternative is to build business credit first, optimize entity structure, then make strategic purchases. Before buying that truck, establish your business entity properly. Are you operating as a sole proprietor, an LLC, or an S Corp? The entity structure dramatically affects how vehicle expenses are treated for tax purposes. If you are an S Corp owner who have the business own the vehicle, follows very different rules than a sole proprietor who owns it personally. Neither is necessarily better, but you need to understand the structure. In our Monday Night Clarity Compositions, we walk you through how to get this done. We help you to understand which approach optimizes your specific situation, and we show you how to document everything properly. Before spending on wants, now here's the next thing I want to talk about. The financial foundation with tax planning. And you really should be thinking about this before you start spending on wants. You should be building your financial foundation with tax planning built in. The first foundation element that you should think of is the emergency fund that includes tax reserves. Not just 3 months of operating expenses, but 3 months of expenses plus your estimated tax obligation. When you calculate 3 months of reserves, include the quarterly estimated tax you'll owe as well. This will prevent nightmare scenarios when you have money expenses but you can't pay your taxes, and suddenly you're facing the IRS payment plans, penalties, and interest that compound your problems. The second element that I want you to think of as part of your foundation is to create essential tools that are legitimately deductible. There's a huge difference between tools that you need to generate revenue and are clearly deductible versus purchases you're trying to justify as business expenses when they're really personal wants. A contractor needs quality tools. That's a legitimate business expense with clear tax benefits. Fancy truck upgrades and premium features, those are personal preferences and don't improve the tax deduction and might actually create audit risk if you're claiming 100% business use for a luxury vehicle. Now, the third foundation element that you want to think of is proper entity setup and tax strategy. Before major purchases, get the entity structure right. Form an LLC or an S Corp if appropriate for your situation. Understand how different entities treat vehicle expenses, depreciation, and deductions differently. We help members throughout this entire section and setup. This decision affects everything: how you deduct the vehicles, how you handle health insurance, how you pay yourself, how you file taxes. Get it right before you make major purchases, not after. Now, the fourth element is documenting things so you have a system for IRS compliance. Set up a mileage tracking, a receipt capture system, an expense categorization system before you start claiming deductions. The IRS can and will disallow deductions you cannot document properly, even if they were legitimate business expenses. So let's remember this. That first big check in your business is a test. Will you build a sustainable business with a smart tax planning, or will you make emotional purchases justified as tax write-offs without understanding the actual rules? The new truck isn't just a truck. It's a symbol of every major purchase motivated by a tax myth instead of tax reality. It's a write-off. Doesn't mean it's free. It means you can deduct a portion of it and you'll follow specific rules, maintaining proper documentation and use it legitimately for business purposes. Build a foundation first. Emergency fund, including tax reserves. Essential tools that are clearly deductible, proper entity setup with tax optimization, and documentation systems that support your deductions. Now, every Monday night at 7 p.m., we meet in the Clarity Compass Method membership to build these foundations with tax planning included. If you want tax compliant bookkeeping and planning handled for you, our white glove services provide exactly that. You get accurate categorization, proper documentation, and entity-appropriate treatment of expenses, and guide us on what's actually deductible versus wishful thinking. So, thank you again. Thanks for tuning in to the Tax Season Saturdays, and I'll see you next week on the next episode. Bye.
Hey, thanks for joining this Saturday's tax season special. Don't forget, you can join the Clarity Compass membership for weekly support or reach out for our white glove bookkeeping services. And remember, we're not lawyers or accountants, just your guide to clarity. Catch the next Saturday episode in this special tax season series. See you then.